So today we're going to go over investing order of operations. This is kind of like an in-house mental framework that we use here at Rust Belt Capital when it comes to investing and keeping us from going astray, or how to make sure that we make consistent investments that we are more likely to be successful than not with. So next is our disclaimers. We are a private investment firm. We're not a registered investment advisory. We're a small private equity firm here in Northern Ohio. Um, Consult with a financial advisor or CPA or something like that for tax advice and for professional advice. So, to make sure that we don't waste your time, let's talk about who this presentation is actually for. Then we're going to go over the difference between investing and gambling, which there is quite a misunderstanding in popular culture between investing and gambling, just in the level of understanding when it comes to investing in ways people talk about it. Then we're going to go over why the order of operations when it comes to investing is important to know. And then we're actually going to go over the order of operations when it comes to investing. Sounds simple enough. So, who is this presentation for and who does this framework apply to? So, first of all, who doesn't it apply to? This really isn't going to be very helpful for the people who are super passive when it comes to investing. That's you have a 401k, an IRA, self-directed IRA, you just do index funds, and you just really cling to diversification. You're not really interested in doing too much. You just know that you need to invest something. You're just going to put it away and it's going to do what it's going to do. This presentation really isn't going to be very useful for you. Now, it is going to be useful for people who are semi-passive and semi-active. And what I mean by that is maybe you have a 401k, an IRA, index fund, stuff like that. But you do some individual stock picking and you want to, enhance your ability to do some individual stock picking. We're going to, cover how you can do this and how you can, increase the likelihood that you come up with the correct or increase your likelihood of a better investment returns. Um, we're not necessarily going to get into the weeds and the technicals or mechanics or anything like that, but the framework is very, very important. And then lastly, obviously, this then would apply to professional full-time investors, such as those who work at Rust Belt Capital, and so on and so forth. So, what is the difference between investing and gambling? Now, this is actually a social media post I wrote down one night when I was just thinking, and I said, let there be no confusion between investing and gambling. Gambling is when the odds are outside of your control and are stacked against you. Investing is when the odds are somewhat within your control and you stack them in your favor as much as possible. Iterate over both scenarios several times and you will see a clear difference. One is mindless and one is calculated. One is random and one is thought out. Now, this brings us to a picture of a casino, right? So that makes us think, how do casinos stay in business? Statistics and probability. Okay. They've literally stacked the odds in their favor. They are the house, and all they need is people to play enough times that they win and they make a lot of money. That's why casinos stay in business. So when it comes to investing, we aren't gambling, but if we're gonna use that kind of framework or that thought process, we want to stack the odds in our favor. We want to be the house. We don't want to be the gambler. So that brings us to our premise, which is we want to stack the odds in our favor. So, why is the order of operations or the investing order of operations? Why is it so important? So, first of all, I've been saying order of operations quite a bit, but what is the order of operations? Well, in math, the order of operations is the rules that tell us the sequence in which we should solve an expression with multiple operations. We need to follow this order in order to get the correct uh, answer. So here's an example. Here's something that really doesn't take an order of operations because it's a super simple math expression. It's 1 plus 1. Well, we all know that 1 plus 1 equals 2. This would be the example of, saying I need to put something away for later. You're very low conviction. You're not really engaged. You're just doing the bare bone basics. But what if we move on to more challenging expression, math expression, for example? Say we have 4 times 5 plus 3 in parentheses. Well, one way we could try to approach and get the answer for this on what it is we could say 5 times 4, which equals 20, and then add 3. Well, that gives you 23. The problem is that's not the correct order, and therefore the answer is wrong. If we try it again and we actually follow the order of operations, well, we know that whatever's in parentheses, we have to do first. So we go 5 plus 3, which gives us 8. Now we can move outside of those parentheses and we can solve from there. So now we have 4 times 8. Well, 4 times 8 is 32. And this is the actual correct answer. It's correct because we followed the order of operations. So what we can conclude from this is that the correct process increases the likelihood you get it correct, at least in investing. And disclaimer there is that when it comes to investing, you can still follow the correct process and get it wrong, and you can still lose because there are some things that are just outside of your control. So, why is the investing order of operations important to know? Because it provides a framework to help keep us from going astray. And it's a repetitive process that we can follow again and again and again, rinse and repeat. So let's get to it, shall we? Okay. So the first thing in the order, or the first part of the order of investing order of operations, is to have knowledge. Now, this sounds basic, but have you ever heard me talking about time or time to buy? Or they're asking for hot stock tips, or they want to know what's going to go up real hot, or they're following the crowd. Hey, did you see this? Did you see that? Like, all of these are not knowledge. These are terrible questions. Terrible, terrible questions to ask. You should not take any investing advice from people who are talking about any of that stuff. Instead, when we talk about knowledge, we want to know, what do I have an unfair deep knowledge of? Why? We want an intimate and unrivaled subject knowledge on the assets we invest in. Okay, so what do I mean? What I mean is, think of one very, very tight asset class. Okay. So when I say, what is something that you have an unfair knowledge uh, advantage in, some people might say, well, real estate. Well, that's a bad example. Or they might say commercial real estate. Well, that's also bad. Or commodities. Well, that's also bad. Why is it bad? Because it's still, even though you've narrowed it down, sure, a little bit, you haven't really got nuanced into it. For example, here at Rust Belt Capital, we specialize in non-college, B-class, value-add, affordable multifamily real estate in Western Ohio. Even more specific, generally our client base within those apartment complexes are older, say 40 plus. Why is it important to be this detailed on what you're doing? So I could even give you an example of, say you're in technology, okay? That's not a good example of just technology. Maybe you're specifically within semiconductors, or maybe you're specifically within gaming, gaming producers or something like that. Really, really focused on a certain segment of an investment industry. So why is that important? Because it's impossible to know everything about everything. And so what you need to do is narrow it down to where you know the right questions to ask. So what are the right questions to ask? Um, you need to be able to answer, what are key drivers in our niche? Who are our key competitors if I'm investing in a certain asset or a certain company? What are some areas of obstacles that might be coming up in the future that maybe we can control, maybe we can't control, and so on and so forth? Because now you can actually start asking educated questions. When I was first getting involved in investing, I heard this phrase and it was really, really good. A lot of times it's very difficult for people to be successful when they're starting out because they don't know what they don't know, and they don't know what they don't know. Or they don't know what they should know, and they don't know that they don't know it. So I messed it up the first time. So the correct sentence or phrase or whatever is, you don't know what you should know, and you don't know that you don't know it. Well, if you don't know that you don't know it, you can't ask the right questions. So it's all about asking the right questions. And in order to do that, you have to have a very, very deep knowledge base. Now, you might be saying, hey, Stephen, I don't have a deep knowledge base of something like that. of a certain industry or certain segment? My answer to that would be yes, that's very possible. Probably that's where you're going to be. Most people start there. So I put, it is possible you might not have a deep knowledge of any business type or industry. No big deal. In that case, learn one. If there is not one that you know extremely well, learn one. That's what I did. When I got started investing, I didn't know anything. It took me years. And then over time, you learn more and more, and you get more and more specialized, and that's where you start doing better. So I would give a pro tip though, if you are going out to learn something, look for businesses that are simple. For example, would I rather invest in a garbage business that picks up trash like waste management, or would I rather invest in a technology business that makes some type of software? Personally, I would rather invest in a waste management business because it's more simple. Now, I'm not necessarily saying go out and invest in waste management stock. Okay. I'm giving that as a example. Okay. So simple is better. I personally prefer to look for those versus more sexier complex sounding businesses, because complex just means more ways to mess up. Okay. Simple scales, fancy fails. I.e., this is why Rust Belt Capital looks at multifamily. It's a very simple business model. It is well understood by us investors, so it's well understood for other people to concur with our valuation process, and is well understood by debt providers, which helps us get leverage as well. So after we have knowledge, then it comes to managing risk. But what is risk? It's pretty important that we're all talking about the same thing. So I think I said it's impossible to manage something you can't define. So how would we define risk? Let's look at what Warren Buffett says about risk. Most great investors at some point have studied what Warren Buffett says, and I would be falling into that camp as well. So Mr. Buffett says diversification is a hedge against ignorance. Well, let's break that down. What does it actually mean? Diversification is a hedge against ignorance. Well, what does hedge mean and what does ignorance mean? Well, the word hedge is just analogous to insurance. Basically, you're just insuring something. And ignorance just means lack of knowledge. So, diversification is essentially just insurance against lack of knowledge. So, back to our original question, how would we define risk? We would define risk as a lack of knowledge. Okay. Goes back to kind of our first hint. If you uh can't define something or you don't understand something, how can you manage it? Right. Now, if we're sitting in a finance class in a university, or we're going to talk to academics, they would define risk as the probability of performing different than we intended. That could be outperforming, that's a risk that you overperform, or underperforming. Most times people look at risk and they think of it in a negative context. So it's making sure that we're having the same understanding of what risk is. So, okay, now that we have the same understanding of what risk is and we've defined it, how do we manage it? So, to manage risk, we can ask ourselves three pretty simple questions. The first one is, what does this look like, or what does this investment look like if it goes south? Now, if you're honest with yourself and you really think about it, you'll come up with an answer, and you can write that down. The second question that we need to ask is, what is the actual likelihood of that? Okay, so maybe we're trying to fill up a property from 80% occupancy to 90% occupancy. What is the actual likelihood that we're going to be able to do that? Or what is the actual likelihood that we're going to be able to get the rent increases that we're looking for? This is how we understand and risk, and we're trying to quantify it at this point. And then the third question we're going to ask is, what can be done to limit the possibilities of a bad outcome? So if we need to raise rents, okay, and we're not 100% sure that we can get the rents that we're looking for, what does it look like if we can't? What is the likelihood? What's our worst case scenario on where we can raise rents to? And if we're in a negative levered position, or we have how do we hold on to this property is basically what we're coming to. Maybe we have a higher cash reserve, and that gives us more time. More time, it gives us the ability to actually work our way out of a problem. Um, so what I have then is, based on your responses to these three questions, you'll have a better, more intuitive grasp of the risk you're actually looking at. I think this is the best way to actually quantify risk and to understand it, rather than some type of, you know, fancy model or even though we do that, or using a beta term or something like that that you would hear in a finance class. Now, let's make sure I'm actually very clear. I'm saying, to be clear, let's have position limits, i.e., we wouldn't take $100 million portfolio and 100% go into one company. That's not prudent in our viewpoint. I wouldn't do this. I don't suggest other people do this. And don't confuse this with exposure to a sector either. So, after we have knowledge, after we have managed our risk or we've understood it a little bit, then it comes into quality. Okay. Generally, when it comes to investing in the stock market, my recommendation is to look for the best of breeds. Okay. I get this from listening to Warren Buffett and Charlie Munger, and they'd rather pay a fair price for a superior asset than a cheap price for a inferior asset, right? So quality pays dividends that are hard to quantify. These are the intangibles. How often have you went with a cheaper product versus the actual product that you want? Basically, you bought a knockoff and then you regretted it. Think about this. Maybe there is some phone or something that you wanted to buy and you're like, that's really good, great quality, but I want to save a few bucks. And so, I mean, I get pretty much the same thing and I can save a few bucks. So I'll just go with that. I don't know about you, but for me, most of the time when I do that, I end up regretting doing that. And I wish I would have just bought the quality product to begin with and paid the extra price. So let's apply this to investing. If you have two companies you're looking at or two properties you're looking at, should you save a little bit of money or should you probably try and buy the better quality property or better quality company? Now, I'll give another example of this. I grew up on a farm. Okay. I grew up on a farm where there was swamp ground. And so we needed to drain the fields that we have. Okay. So to do that, we install what is called field drainage tile. Okay. Now, on the surface, generally, most fields are relatively dry where we are today because of old infrastructure that was put in place, like ditches and stuff like that 150 years ago. However, we still might invest in brand new, very expensive field tile, even though it might not pencil on the surface. Why would we do that though? Because there are intangibles of this increasing of the quality of ground that are hard to quantify. So yes, extra field tile is going to reduce extra moisture in the soil, which is good. But what it also will do is it allows us to get in and plant earlier. So we can grow our crops when they need to be grown, or plant our crops when they need to be planted, or we can harvest our crops when they need to be harvested. Um, and then the yield boost that we get out of that, or the quality of our grain, the increase in quality of our grain, like we can't necessarily write that down on a pad and paper and say exactly what that is, but you notice it when you're a true operator and you're actually really good at what you do. And the same thing's true when you're a true operator in terms of investing, you're a true investor. There's these intangibles that you realize and you know, but you can't 100% pencil on paper. Okay, I already did that example. So this saying that I have, and I thought this was, maybe a dad joke or something. I thought it was really good. A saying that I would say to take to the bank is putting lipstick on a pig doesn't increase the value of its bacon. Okay. Think about that. So on to the next thing in the order of operations. We had knowledge, managing risk, quality, and now price. And there's an important reason why we put quality in front of price. Quality is superior to price. Price is what you pay, value is what you get. So misconceptions when it comes to investing are phrases like buy low, sell high, cheap is better, penny stocks offer more upside. All of this is very much wrong. That is not how that works. Okay. So here's a trade-off we often think of and get incorrect is we're looking at quality, and we're quality versus price, and we're looking at it on a scale, and we don't exactly know how uh, to do it. We're going to say that cheaper is better than more expensive, and that's not true. Um, Generally, the better pick, if we're using a Rust Belt Capital framework, is quality trumps price every time. Quality is superior to price in our book, in our framework, in our playbook every time. So within reason, obviously. So how do you outperform then, right? So a lot of times people think, okay, I need to buy at a really cheap price and then it needs to appreciate a lot, and that's how I outperform, and that's how I do better than the stock market, or that's how I have a superior investment. Okay, let's go back to the saying that we started with: price is what you pay, value is what you get. Okay, so if we're paying a price, like look at the scale on the screen right now. Uh, our quality is heavier than our price, even though it means that we're probably having to pay a little bit more on the price side. But if our quality is true quality over time, that quality is going to start outperforming the inferior asset classes, because you can't fake quality. So this is actually inherently what investment analysts are supposed to be looking for, is quality over price, and trying to find this growth that comes in there. Are they able to do that? Who knows? So once you find, let's go back to price. Price versus quality. We're trying to find this trade-off where it actually makes sense. Okay, that doesn't just mean pay any price for any type of investment. It has to make sense. Okay, so that's what the investment analysts are doing, is looking for the trade-off between price and quality, which is can be challenging. But we would say, don't be afraid to pay a little bit, keyword, a little bit of a premium for quality. Then what do you do after that? We get to our last step in the order of operations. So to review, our steps in the order of operations were knowledge, managing risk, um, quality, and then price. Lastly, it comes to time invested. So once we've uh, have this quality versus price scale figured out, and we've made our investment, what do we have to do? Well, now we have to let this scale actually balance it out. Okay. And this can take years, not days, weeks, months. It can take years. Maybe it's a year, maybe it's 2 years, but it's better to think in years, like 5, 7, 10 year time frames. And so if there's any chart or any page on this thing, on this presentation, that's actually worth taking home and really, 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 really remembering, it's this one right here. It's right in front of us. I have two screenshots on the slide that demonstrate $25,000 invested, making 10% per year. And the only difference on these $25,000 investments is their time frame. So the first screenshot is a growth of 25,000 at 10% a year over 10 years. And the end result is $64,843. Okay. So you did a little bit better than doubling your money. Okay, cool. Now, the second screenshot is the same 25,000 at 10%, but compounded over 40 years. The end result is over $1.1 million. And that $1.1 million is going to make over $100,000 in terms of value gain the next year. Okay. This is because money grows when it's invested in a compounding asset. It grows at an exponential rate. What does that mean? That means that 80% of your gains come in the last 20% of the time, otherwise known as the Pareto principle. 80% of your gains will come in the last 20% of the time. And the longer you get it, the much higher it's going to grow. Okay. This is why when I talk to young people, after I tell them, boost your income, that's the first thing you need to do, is get your income to 100,000 plus per year. The second thing you need to do is start investing, because if you're 25 years old, coming up with $25,000 isn't actually that hard, if we're being honest with ourselves. And if you invest in something that can make 10% per year, roughly speaking, on average over 40 years, that comes out to $1.1 million by the time you're ready to retire, which is still going to be a meaningful amount of money in 40 years. So Probably the most important slide on this page is the time invested. Next, just to kind of go over our 5 points that we have when it comes to the investing order of operations. Start with knowledge, to managing risk, then the quality, then the price, and then the time invested. Put all 5 of these together, and you're going to dramatically increase the likelihood of doing well and performing or outperforming the markets. There's still the mechanics of it, but this is generally the framework you need to do. And this is the framework that we take in our investing approach again and again and again here at Rust Belt Capital. So, who is Rust Belt Capital? Well, you have yours truly, Stephen Speck. That's me. I'm a managing principal here at Rust Belt Capital. I have 2 undergraduate degrees from the Ohio State University, one in cognitive neuroscience and one in agricultural business and applied economics. Our partner, or my partner, Nathan Spitler, he is also a managing principal here at Rust Belt Capital. He has a Bachelor of Science degree from the Cornell University, and he also has a law degree from the University of Toledo. Rust Belt Capital. Who are we, and how do you get in contact with us if you're interested in learning more about what we do? We are a private equity firm, a small private equity firm here in Northwest Ohio. We specialize and focus specifically at the current moment in multifamily. Like I said earlier in the presentation, if you're interested in getting in contact with us, you can shoot us an email at investor@rustbeltcapital.com. You can also go to rustbeltcapital.com. You can email me, Stephen@rustbeltcapital.com, and we will get back to you. Last is just the disclaimers. So, anyways, I hope this presentation was helpful for you. If it was, please like, subscribe, share, give a thumbs up to this video. It's definitely helpful. If you want to get our once a week emails, go to our website, rustbeltcapital.com, and in the footer, you can sign up for our weekly emails. Tons of educational free content coming to you every single week. So thanks for watching.